This is Planning for Long-Term Care, the podcast with Key Planning Partners.
Welcome to the show. We're sitting here with Tom Vasello and Marie Colbert from Key Planning Partners, and we're going to talk today about planning for the future and different ways for you to plan when it comes to extended care. So, Tom, what are the different ways you can fund your planning?
Well, there's a number of different ways to fund long-term care. You want to look at the different tax advantages that you may have. Some people may have old annuities that they purchased years ago. They have a lot of gain in it, and every dollar they take out is going to be fully taxable to them. But thanks to the Pension Protection Act, there's changes that can be made to that annuity so that those funds come out tax-free if you need it for long-term care.
What is the Pension Protection Act?
There was a law that was passed several years ago that basically encourages people to plan for long-term care. The government saw that there was an unfunded liability coming forward regarding all the baby boomers turning 65 and the amount of long-term care. And it just carved out some real tax advantages for people that want to pre-plan for long-term care.
What are some of the main tax advantages you can take advantage of?
Well, there's several. There's some with Pension Protection Act, which would allow you to take this annuity that if you just withdrew the money, it would all be taxable income to you, which could affect the amount of your Social Security that's taxable. It can affect your Medicare premiums. But if you need it for long-term care, it'll come out tax-free. It'd be a lot like a healthcare savings account, but specifically for long-term care. And it's really the only way you'd be able to access those funds tax-free.
Also, a lot of people think of long-term care and think that they hear single premium, or there's a lot of different ways that these new products will allow you to fund, whether it's a single pay or a 10 pay, 20 pay, or even a lifetime pay. So there's options there as well.
When you're saying the 10 pay, 20 pay, what does that mean in particular?
So that means that you're going to pay for 10 years, an annual premium, years 1 through 10, and then you're done. 20 pay would be the same after the 20th year, you're done. And we would look at, based on your individual situation, which one may be more advantageous than the other, and even compare it against a single pay as well as a lifetime pay. Because
everybody's unique, right?
Exactly.
Everybody's got different situations.
And Tom, that may be
there's never a one-size-fits-all approach when it comes to long-term care. We need to take a look at what your situation is, what type of assets you own. Do you have IRAs or 401ks, qualified money? Do you have non-qualified annuities? Do you have old life insurance policies that you don't need anymore? We can take those assets and leverage them for long-term care and tax advantage ways. And we're getting a little stuck on the financial side of it. People need to put together a plan for long-term care as well and talk to advisors regarding it. I've been specializing in long-term care for 29 years now. And one of the things I see when people are planning in crisis, maybe they're helping their parents out who have dementia right now, they don't really know what their parents' desires were when they were still their parents. And many times those children feel almost guilty, and we don't want mom to go in an assisted living facility or dad to go into an assisted living facility. We'd rather have them move in with us, which would be an extreme burden on the children. And when their parents were still their parents, I'd be willing to bet they didn't want that. They did not want to become a burden on their children. So you want to make sure you have a plan that can be communicated to your children, even if it's to the point where you can't speak for yourself.
Sometimes it can be an uncomfortable conversation, but it's one we all really need to have.
Well, you don't even have to have the conversation because we have tools that can allow you to put together the plan, and your kids you don't have to have the conversation with your kids until you actually need it. But now all of a sudden when you need it and there's a plan there designed, the kids can follow that plan and have a lot more comfort knowing that they're doing what you wanted them to do.
And also to add to that is a lot of times with the plan, before with the traditional long-term care policies that I'm sure many people have seen their parents may have had, they paid all of this premium into it. And if they didn't use it, they didn't get any benefit. Well, in this situation, they're planning for the future. They're paying these long-term care premiums. But if they don't use it, there's a tax-free death benefit to their beneficiaries. So it's not something that you're going to pay for and never get any benefit.
And one of the things that I always hear when we talk about this is a huge benefit is the peace of mind for the person that's planning. There's if you've got kids, if you've got a family, things like that, there's times that you're kept up at night wondering, like, how am I going to do this? How's this going to happen? and it becomes a bigger burden as you move on. Like, oh my gosh, I don't have a will, I don't have this. It's the peace of mind with the planning that
Correct.
really helps. I mean, that's what you're buying.
You're buying peace of mind. You're also buying leverage. You're setting it up so $1 can do the work of $4 or $5. So you're protecting something for your kids. The other thing that you're buying, I saw a recent statistic, as soon as a parent moves in with a child, on average, it's going to cost that child $655,000. And that's because they're reducing their hours at work, they're passing up promotions, maybe they're retiring early. That means that they aren't contributing as much to Social Security, their pension plans, their 401ks. And over their life, it's going to cost that child $655,000. And if parents really know that, they don't want to become a burden on their children. They want to put together a plan ahead of time. It's just if you wait too long, you get to the point where you may not be in your right mind. You may not be thinking as clearly as you are today. And then your kids have to guess what you want. And your kids are your kids. They're going to be there for you. They're going to do what's needed. But you may not want to put your children in that situation.
And speaking on that note about waiting too long, I think some people have the misconception that maybe a certain health impairment may preclude them from qualifying for long-term care insurance or for that leverage that Tom is talking about. But I'll let Tom kind of expand a little bit more on, the different options that we do have, whether you're young and healthy or you're already in a nursing home.
Yeah, all planning is about creating leverage. It's about using $1 to do the work of $4 or $5. And it was Archimedes that said, give me a lever long enough and a fulcrum strong enough and I can move the world. And it's true. If you're young and healthy, there's a lot of leverage we can create for long-term care. But even if you're currently in a nursing home or currently in an assisted living facility or receiving home health care, there's still plans that can be put together. We can't create as much leverage as we can for the young, healthy person, but there's plans that can be put together to make sure that care is sustainable.
Right. So when I'm putting together my plan, what are some concerns that I should have?
Well, one thing we want to understand is where would you want to receive care? Not only the type of care, and most people want to stay in their own home as long as possible, and then where would they go after they were done after they could no longer receive care in their own home? But what part of the country would you want to receive care in? The state of Connecticut, it's much more expensive to receive care than it is in Florida, for example. So if you want to go back up to Connecticut to receive care, it's going to require more resources than it would be in Florida. The other thing you want to understand is how much responsibility do you want your family to have? When you're in need of care, do you want your children to be your caregiver, or do you want your children to be your children?
I think also looking at the amount to insure. You don't always have to insure the full amount of what the long-term care costs would be. You see what you can self-insure and then insure the gap there between.
Yeah, I'm a big believer that no one should fund the entire amount through insurance. There's some amount of care that you can afford to self-pay. Now let's make sure we insure the difference so you don't impoverish a healthy spouse or you don't spend down all of your assets. You have something that goes on to your children.
Right. And so when they go through the planning, do you find that do most people like to involve their kids when they're doing their planning, or is it more that they're like, I want this in place for myself, knowing so my kids don't have to deal with any of it?
It's about 50-50, honestly, about 50%. And we would prefer the children be involved, but about 50% of people do want to involve their kids. They want to make sure that they have that conversation. I have this plan in place, not only, some type of maybe insurance plan, but I want these accounts used if I need long-term care. This is where I want to receive care, even as far as, I want to go to this assisted living facility over on this street here, if it need be. The other 50%, they're just not ready to have that conversation with their children yet. And we actually have a system in place that you can put down all of your wishes. It's not a legal document, but you can record all of your wishes, where you want to receive care, which accounts they should use. For maybe it's one of your children that has your durable power of attorney rights. And that's communicated to them only when you actually need care.
Right.
So
the durable power of attorney, that's a big thing too. Say you have 3 kids. One kid might be the more emotional one. One might be the more business heady one. One might be the organized one who's good with money. So in essence, you kind of want to put together your team with your kids and make each one of them in charge of a different sort of portion, right? Is that
There's the financial and the legal side of that interfamily relationship. Kids are different, and now to make it even a little bit tougher, they're not all in the same area anymore. They're spread all over the country. So you want sort of the more prudent one to maybe be there on the financial side. You also need a healthcare surrogate designation. So there's the person that can make the financial decisions and legal decisions for you, and then someone else, or maybe all three of them, that make the healthcare decisions. But you also need to communicate that on the care side, because I've seen a lot of families, children and siblings, that have been torn apart because the parents didn't have a plan, and the care burden doesn't fall equally among the children. You may have 3 children. One of them may be a girl, and we see it fall disproportionately on daughters. And then it also depends on who's local, who can provide care.
Right.
And if all of a sudden, there's one family member that's, mom's moved in with, and that they're having to cut back their job, like we said, it's $655,000 as soon as they move in. How unproportionate is that? Is the burden on that child? And the other children, even if that child isn't worried about it, the other children may just guilt themselves into an issue. So.
And that's where, living wills are a big portion of that too.
Living wills, healthcare surrogate designations. There was some individual that made a lot of press in the Tampa Bay area that if she had a living will, we never would have heard her name, but it turned into a 4 or 5 year court battle. And
that can be ugly too.
Oh, yeah.
That's when it runs into probate, right?
Mm-hmm.
Probate is like a really ugly word. Everybody always, you hear it's an ugly word, but I mean, is it as really ugly as, people make it out to be? Like, because whenever you hear like, oh, did you hear they went into probate?
It can be.
This is the problem with probate. It's so easy to avoid. I mean, you go down to the bank with your payable on death designations. You fill out a form. That account's not in probate. Have your beneficiary designations right. Other than real estate, you can avoid probate everything, without much legal work at all. The problem is when people pass away and they don't do any planning, and the entire estate ends up there in probate. And, people say they may pass away without a will. I like to say, yeah, well, you have a will. It's just in our case, the state of Florida has drafted your will for you.
And that kind of leads into is, reviewing all of your current policies and bank accounts and how are they titled and who's the beneficiary. And that may open up an opportunity of, if you have an existing life insurance policy, there's a possibility that you can use some of that cash value to fund long-term care if funding was one of the concerns. So there's a lot of different options that are available, just a matter of sitting down and having everything in one place.
Right. And one of the terms that I heard from an attorney when we were talking about probate, he said, well, here's the thing with probate. The only person that wins in that is me.
Right.
That's true.
Attorneys love probate.
Yeah,
that's for sure.
Yeah, he's like, I'm not going to lie to you. He's like, I make a lot of money off probate, but that's because people don't go through and plan.
And it's funny, you don't see the attorneys advertising to do reviews of current policies or changing, and that's could be a big reason why.
And even right as you're going through it, you would think that's when you would make a correction. We just had a client that came in. His wife just recently passed away, and there's about $7,000 sitting in a checking account that was in her name only, and he can't get to it until it goes through probate. And, I'm sorry, she didn't put a payable on death designation. She could have easily filled out a form. And the next question I asked them was, have you done that on your accounts yet for your daughters? Well, no, I haven't.
You better get on it.
Yeah, get on it and do it right now. It's the same thing. People may be experiencing issues right now with their parents when it comes to long-term care. Look at all the work you're going through, all the turmoil you're going through with your parents. Don't you want to avoid that for your children?
And it's simple steps that I think a lot of people know they have to do it and are putting it off. And by actually sitting down and doing it, it's going to take far less time than the time that they're worrying and putting it off till the next day.
You're listening to Planning for Long-Term Care with Key Planning Partners. If you'd like to receive a free copy of Marie's book, Tax-Free Money for Long-Term Care, call 888-PLAN-LTC. That's 888-752-6582.
We're sitting here with Tom Vasello and Marie Colbert from Key Planning Partners, and we're talking about planning when it comes to your future and long-term care. Is there a best time to start planning?
Yeah, today. I mean, really, the earlier you do it, the better. Because as you get older, as you go through health problems, there are options that come off the table. Now, I can put together a plan that helps create leverage and makes things easier for a 25-year-old or for an 85-year-old that's in a nursing home right now. But the choices available to that 85-year-old in a nursing home right now are very limited, and they aren't great choices. So you really want to look at it as soon as possible. Even if you don't think you have the funds, if you think all we're talking about is long-term care insurance and long-term care insurance is too expensive, we can literally design a plan for any budget, to make that plan fit. That plan may or may not involve some type of insurance or some type of investment product. It just depends on what your situation is.
And going back to the Pension Protection Act, I think, Tom, you can speak to a lot of times it's tax planning. It's not necessarily long-term care planning. It's tax planning. How can we leverage our dollars? And the Protection Act allows you to do that. So,
one of the things that's always struck me in this market is the long-term care plan is always driven, when you have a couple, it's always driven by the wife.
Really?
Many times the husband is resistant to it. And it's not because they don't want to plan. In fact, a lot of times they'll say, you know what, I don't want to plan, but I want to make sure my wife's taken care of, so I want to make sure she has a plan, so let's do a plan around her. But if you really want to take care of your wife, you don't want her to have the plan. You want to have the plan because you want to make sure if something happens to you, you don't spend down your entire life savings and impoverish her on your care. If something happens to you want to make sure you don't burden her with your care. And the men, when you point this out to them, it's not, that's the way they were thinking. They wanted to take care of their wife. They just didn't think it through.
And how many times do you hear of somebody who's needing long-term care and it generally, the first is going to be the husband and the wife is taking care of the husband. And in reality, it's so hard on them physically, emotionally, mentally. It's bringing them down to where chances are they're going to have a long-term care event in the near future when they're done taking care of them.
That's a great point. The whole point of, it's I don't want to be, sound sexist or anything, but in being a man, one of the things I think about is how do I take care of my family? How do I take care of my kids, my wife, things like that? And my initial thing would be like, I want to make sure she's taken care of, so let's get all her stuff done. But really, if I'm getting all her stuff taken care of, the only person that's taken care of is me. You're
protected.
If something happens to her,
But that wasn't your intent.
Right, not at all.
Right.
That's a great point.
And by the way, taking care of you, if you don't use it for those long-term care needs, it could be going back to her in a form of a death benefit, tax-free.
Okay.
One of the big objections in the past, we had the old type of long-term care insurance that had a lot of problems. One of them was you could pay premiums for 10, 15, 20 years, and if you never needed it, those premiums were spent and they were gone. It was use it or lose it for long-term care. Those aren't part of the plans today. The plans today, there's a benefit whether you live, die, or quit. The other big problem with old traditional long-term care of the past was they have a real history of substantial rate increases that you've seen that's made press. Again, the plans that we put together now are all guaranteed. The benefits are guaranteed, the costs are guaranteed, the money that you're putting into it's guaranteed. So there's no moving parts. There's not going to be any surprises. It can be real hard if you're, plugging along in retirement on a fixed income and all of a sudden your long-term care premiums double or triple, which has historically happened. That doesn't happen with the plans that we're talking about today.
Okay. And then what's the term I always hear people worried about? If you don't use it, you lose it. Is that something that really...
That's been a problem in the past. Why should I, great, I can spend pennies to protect dollars and create leverage in that old traditional long-term care, but if I don't use it, I've lost the pennies. Why don't I just roll the dice? Maybe I won't need it. If for a male or female that's age 65, there's a 70% chance that they're each going to need long-term care. That means for a married couple, when you do the math through, for a married couple, there's a 91% chance that either one of them or both of them will need long-term care at some point in their life. only a 9% chance that neither one of them will need long-term care. But still, what if I pay all those premiums and I'm part of that 9% that doesn't need long-term care? Well, with the plans today, now it comes back. The premiums come back in the form of a tax-free death benefit. So your family is still benefiting from that. It's not just money spent that you don't receive any funds back from.
And Tom, going to that statistic, which I think a lot of people know but maybe don't realize how high it is, can you speak to the fact of what kind of impact that has on a retirement plan?
Well, here's the problem: is many of the financial advisors they don't proactively talk about the cost of long-term care or extended care with their clients. So it's great. They say, all right, you want to spend X amount of dollars per year. You have this much in Social Security. We can withdraw this much from your assets. You have this in pension. We look into inflation, and great. There's a 97% chance you can make it through age 95 and not run out of money. But if all of a sudden you put in the average long-term care stay for one of them, that success rate drops from 97% to about 45%. And if you both need long-term care, that success rate drops to 5%.
Wow.
And they're not modeling that, where we could take, a few dollars today, set them aside for long-term care. And if you need long-term care, you're still going to be okay through the retirement because you're partially insuring that risk.
And again, like you said, the best time to start planning is now. And even if you start your plan now, that doesn't mean that's the only plan you have. You can make adjustments, right?
Well,
so even if you've got a small amount that you want to start planning with now, as you get older and make more money and you have more of a disposable income, well, not even disposable income, but just more income in general that you need to protect and you want to help things be taken care of, you can adjust that as time goes by, right?
That's a very common thought and problem. Yeah, and the answer is yes, but here's the thought. Right now I have 2 kids in college and an 11-year-old son as well. Long-term care is not the top of my list as far as priorities. I'm paying tuition, room and board. Hopefully they graduate and they get off my dollar, and and then I can afford. But I do still have some extra income right now that I may be putting towards retirement. Well, long-term care needs to be part of that retirement plan as well. And maybe I'm only protecting 10% of the risk today at that lower price. And then when the kids graduate, I can come and, add another solution in there to layer on top of that to combine. That's like saying I'm never going to buy Apple stock because I could have bought Apple stock for $10 30 years ago.
Right.
Well, it's great. You bought some of it at $10. Now maybe we're buying some more at $30, maybe some more at $100 along the way. So you can keep adding to that coverage. Now that's assuming you stay healthy, but you're not going to get as much leverage later on in life. Let's get something started today, and then we can even put together a plan on how we
or you can
purchase
even
more.
Also look at the options of starting with a little less today and adding a COLA rider or cost of living rider to it, so that maybe you have less now, but it's going up over the years.
Yeah, that's a big thing that people worried about, and I think they put it off because they think, well, I need to start this, but once I've started, this is it. So I want to be able to get the best possible. But it's better to have something and to get the plan started than to never get it started until it's too late.
And there's a balancing act there. There's a balance on how much it's worth to you to plan and how much it's going to cost you today. And I have many clients that are on claim that today, while they're on claim, they wish they had purchased more. But the fact of the matter is, if we had tried to force the issue to have them purchase more earlier on, they wouldn't have purchased anything. And they're very happy they have what they have because it's helping out. So, whether you think you can afford it or not, it makes sense to have a discussion with a financial professional because, like I said, we can tailor these plans to meet any budget. It's not going to cover 100% of the cost, but if you do need care, you're going to be much better off with something rather than nothing.
That's great. I mean, planning is a big deal, and it's something that everybody should really think about. Marie, is there something, one thing that you want to tell everybody when it comes to planning for their future?
Planning for your future, I think as we were talking too, going back to the funding, one thing that I wanted to mention is that we also see a lot of times where the children aren't just involved, but they're actually the ones purchasing it on their parents, or they're maybe purchasing it on, we've seen in one case where they purchased it on their mother and their mother-in-law because both their father and their father-in-law had passed. And they knew that that responsibility and that burden was going to be on their family. And there are options where when the child's funding it, they can still have access, 100% liquidity to their money. So it may have been money that they just had sitting in a savings account making little to nothing, and they decided to take it from one hand and put it in the other and leverage it for long-term care for their parents. On top of it, they're going to get a death benefit tax-free should they not use the long-term care benefit. So it's a win-win in those kind of situations, and provides peace of mind for the parents and the children as well.
Is there any time that's too early? Like, say your kids are fresh out of college. Would you recommend that in some way, shape, or I mean, obviously, you always tell them to get in a 401k as soon as you possibly can. Don't hold off, because 401ks, a lot of time, they're free money, right? Is there a time that you would say, hey, why don't you diversify and do this when they're young? Because like you said, it's never too early. I mean, is 25 coming out of college, is that too young?
Well, no, but it'd be a different planning tool for someone that's 25 than someone that's 85. For example, that 25-year-old that's maybe just starting their family, they're worried about life insurance so they can replace their income for their family should something to happen to them. And we even have term life insurance policies that are extremely cheap that can accelerate and pay that death benefit out if you need it for long-term care. And it even extends beyond that. I actually just encouraged my cousins who are, one's in college her junior year, so she's about 20, and the other one's just out of college, 23, 24. They got $1 million of term insurance. Chronic care, critical care is what is the big concern that I look at in that age, which is going to be cancer, heart attack, stroke. They're paying term premiums, which is little to nothing, for $1 million. If one of them were to have, God forbid, one of those events, they would be able to access a portion of that death benefit tax-free to do whatever they want with it. So whether that's an experimental treatment, maybe in another country, or it just gives a lot more flexibility. So knowing that those options are out there are extremely important. And the other nice thing about a policy like that for that 25-year-old, now maybe when they're 35, 40, 50 years old, they may want to transition to a more permanent type coverage. And even if they're uninsurable, they have the opportunity to convert that to a permanent policy with those same type of benefits. So now maybe they're still healthy and there's a better option where they could go through underwriting, but it gives them options they wouldn't have otherwise.
Wow. That's great. This is really great stuff. I appreciate it. So how do people get a hold of you?
Well, they can reach out to us at Key Planning Partners.
Or 888-PLAN-LTC. And really, the best way to do is just either visit us on the website or pick up the phone and give one of us a call. We'd be happy to walk you through, learn a little bit more about your situation and what your goals and objectives are, and see what we can do to put together a customized plan.
So the biggest thing about planning is start the conversation.
Start the conversation and get something in writing that can be communicated at the right time.
All right. Well, Tom, Marie, thank you very much.
Thank you for having us.
It's been awesome.
Thank you.
Thanks for listening to Planning for Long-Term Care with Key Planning Partners. If you'd like to receive a free copy of Marie's book, Tax-Free Money for Long-Term Care, call 888-PLAN-LTC. That's 888-752-6582.